Tether's Q2 reserves have as losses. May top $4 billion Tether's second quarter financial picture deteriorated sharply, according to a report from Wu Blockchain published August 1, 2026. The account, citing Tether's latest figures, said the stablecoin issuer's excess reserves were roughly halved during the quarter and that the overall financial result may have exceeded a $4 billion loss. Tether has not published a line-by-line breakdown reconciling the figure, so the exact composition of the loss is not yet confirmed. The report matters because Tether's USDT is the largest stablecoin in circulation and the default settlement asset across most of the crypto market. When the company that mints it reports a quarter this week, holders have reason to look closely at what backs the token they treat as cash. The buffer that absorbs shock's excess reserves are the cushion Tether holds above the dollar value of USDT in circulation. If every USDT is meant to be backed one for one, the excess is whatever sits on top of that: retained profit, unrealized gains, and assets that give the peg room to survive a bad mark on any single holding. Having that buffer does not by itself break the backing, but it shrinks the margin for error. Tether's reserves have historically leaned on U.S. Treasury bills, with smaller allocations to Bitcoin, gold, and other assets. A quarter that swings to a large reported loss usually points to those non-treasury positions moving against the company. Bitcoin traded at $62,965 as of August 1, 2026, down 2.0% on the day and 1.6% over the week, and the market spent much of the quarter under pressure. A big Bitcoin or gold position marked lower at quarter end can turn an operating profit into a headline loss on paper, even while the treasury book keeps earning interest. A paper loss is not a shortfall. There is an important distinction the $4 billion figure can obscure. An accounting loss driven by unrealized marks is different from a funding gap where Tether cannot honor redemptions. The treasury holdings that generate Tether's core income do not evaporate when Bitcoin falls. They keep paying yield. A loss concentrated in volatile assets tells you the buffer got thinner, not that the token is unbacked. That said, a thinner buffer is exactly the condition that makes the next bad quarter more dangerous. Tether has weathered market fear before, and the Fear and Greed Index sat at 33 in fear territory on the day the report landed. The value of the excess reserve is that it lets an issuer eat a loss without touching the one-to-one backing. Cut it in half, and the same size loss next quarter starts to bite closer to the line. Practical takeaways for holders. For anyone parking value in USDT, the practical takeaways are narrow. First, wait for Tether's own attestation or reconciliation before treating the $4 billion as settled. The Wu Blockchain report frames it as a possible figure, not a confirmed one. Second, distinguish between the mark-to-market loss and the composition of the backing. The question that matters is not, did Tether lose money this quarter, but is USDT still fully backed by liquid assets? A single report of halved excess reserves does not answer the second question on its own. The episode is also a reminder of counterparty risk in custodial stablecoins generally. Holders of any issuer-backed token are trusting a company's balance sheet and its willingness to redeem. That trust is why some crypto spenders route around custodial exposure entirely, keeping funds in self-custody wallets and only converting at the point of sale. For everyday payments, cards that let you spend stablecoins still depend on whichever token you load, so the health of the issuer behind that token is not an abstract concern. None of this signals a peg problem today. USDT continued trading at $1 through the report. The story is about the size of the cushion, and a cushion cut in half is a data point worth tracking into Tether's next disclosure rather than a reason to move at the first headline.